Guys, welcome to today's FOMC prep for the July meeting. Obviously the meeting is over 2 days. They meet today and tomorrow, release a statement tomorrow. So as with our normal prep, part 1, which we do today, is the fundamental prep. Part 2 we'll do tomorrow at the same time, which will be trade ideas, trade plans, etc., etc. Okay, so what we're going to go through today, firstly the Fed mandate, talk about the meeting format, the mandate itself, what they look out for, primarily employment and inflation. Then Brannigan will go into what happened in the previous meeting with regard to the statements, the minutes, the reaction to I guess the statement, but also last time we had a press conference as well. And he'll go through a video price ladder. Then he'll also go through the data since the previous meeting, and then I will go through the normal market pricing and expectations, and also look at some of the key focus points and things to look out for. Okay, so the Fed mandate, you should all know this already. I go through this every time, but it's to support continued progress towards maximum employment and price stability. Now, unlike other central banks, most of them are purely inflation targeting. The Fed has this dual mandate, employment and inflation. It was actually for a long time just employment, but they, post-financial crisis, added inflation to it as well. Okay, and the format itself, it's a bit of a simpler meeting this time. We just have at 7 p.m. London time or 2 o'clock Eastern time, announcement of any change in the Fed funds rate, announcement of any QE or tapering, and a statement release. Now that statement there'll essentially just be a screen dump on Reuters or Bloomberg, be published straight away on the Fed website. Unlike the previous meeting, there won't be a press conference, there won't be an update of economic projections or the dots or anything like that. You won't hear from Yellen, maybe unless she hikes rates. But 7 p.m. is just kind of one trading opportunity really, as opposed to multiple that we had last time round, because we had multiple releases. So I'll just hand over to Brannigan for the time being, and we'll go from there.
Okay, good afternoon guys. Very briefly, okay, I'm not going to go too much through the statement. The important thing is make sure you read this prior to tomorrow. Okay, that's effectively the statement that will be released on the Fed's website. Wall Street Journal does a very, very nice release where on the release they actually show you the changes to the statement. So if you want to take your time, the best thing to do is get that Wall Street Journal website up. The minute the statement's released, refresh your page and you'll see all the changes to the statement. Okay, it's a very quick way to see what's changed if you don't have the Reuters or Bloomberg. What I do want to point out, okay, is what is the changes? You know, it's a summary of what came out of June. Now, very important, the catchphrase or the key line in the Fed at the moment is that the Fed will hike with further improvement in the labour market, and when it's reasonably confident inflation will get back towards 2%. Now, we're going to break that statement down because effectively, guys, that is the crux of the Fed. That is where they are right now. They're happy with what's happening in the employment situation, but they're not quite confident yet that inflation will return to their 2%. Okay, very important. Again, it's a unanimous vote. Right, it did change about, I think, probably in the March meeting. The Fed actually started voting unanimously. So that's quite important. And then obviously the Fed moved dots closer to the market's expectations. Okay, that was the highlight of June. Effectively, the Fed brought their dots a little bit closer to where the market's been pricing. So they became a little bit more dovish. However, they didn't become dovish based on where the market was priced. Okay. If we just move down a little bit lower, we'll see the dots. Effectively, what you can notice here now is the dots now a lot more compact. Okay, so we're starting to see a little bit of a unanimous agreement on the board about, you know, where hikes are likely to be in the you know, sort of coming months. Okay, what it did used to look like was a little bit something like that, so it's a lot more compact now. Right. Also note, obviously, the dots were lowered, so they were, you know, the people that were sitting up higher kind of lowered their dots towards the median. All right, that's effectively a summary of June, guys. Now, very important is what we get out of June, but then what was the thinking? It's so important, you know, it's all good and well reading a statement, but a statement doesn't actually tell you, you know, what the thinking behind various Fed members is. Okay, so what we then do is we look at the minutes from the June meeting. So on the 8th of July, okay, we had the minutes released, and the highlights from that are what's crucial to understand. So the first thing is that effectively the hawks are on the one side saying they actually want hikes right now. Okay, they're foreseeing inflation back at 2% and exceeding, and they want hikes today. Right? Those are the super hawkish. On the dovish side, okay, the doves are sort of sitting there going, well, if we hike now, we're going to make the Greenspan error, and we're going to hike too soon, derail the recovery, and it'll be the end of the world. Okay, so at the moment, you've still got the hawks and the doves that are fighting, right? But you have got a general consensus view sitting in the middle of the Fed at the moment. Okay, Greece was cited. Right? It was very, very well spoken about that Greece was a concern. Okay, and that if there was a Grexit, that would effectively impact on the US recovery. Okay, so important to understand that, guys, because now Greece is effectively out of the picture for now. Okay, Greece in theory has an extended deal for now. All right, so the Fed will be a little bit more relieved. There will be Fed members that will say, you know what, actually thumbs up, Greece is sorted, you know, we could see a continuation of the recovery. And then labor conditions continue to improve, okay, so they're still going on this chorus that the labor market is nice and strong and it continues to improve. And we continue to see this slack or the gap, the labor resource gap diminish. Okay, they did reference, so important, they referenced that gap to be closed by year end. That's the first time we've kind of heard someone put a date on it. So they're saying, in theory, by the end of the year, we will be at full employment in terms of labor utilization. More importantly, that means wages should start to accelerate because demand will start to exceed the supply of labor. Okay, so again, you're starting to get an idea of the thinking of the Fed. The Fed are thinking that as that gap gets fully utilized, in essence, wages will pick up and inflation will be a byproduct of that. Okay, so they're talking about the end of the year being full employment. And then, okay, very important, data dependent. Right? A lot of members said they'd like the Fed to be data dependent even once they hike. Okay, and that's so important, guys, because what that means is effectively you can get away with it in this day and age with hiking this month, saying that, you know, we could cut rates if data gets worse. It's almost like the Fed can almost hike with no real implications if they get it wrong, because then they can just cut again. Okay, so important to understand that they wanted to remain data dependent. Very important in terms of market reaction. All right, we will go over the video from the June meeting tomorrow, okay, just to see what the price response was, particularly on the release. Right? But more important, the actual, the response of the market to the June, the June minutes was very, very, very non-existent. There was nothing, guys, absolutely nothing. Now, the reason I want to point that out, okay, is because in essence, tomorrow's meeting could be a damn squib. It could be huge. Okay, but what I want you to understand is if it is a damn squib, you can expect it to be very similar to what we saw in the June meeting or the June minutes release. Okay, so that's effectively the minutes. Let's then move on and talk a little bit about one or two other things. Okay, so important. We've heard two additional pieces of information from the Fed. Right, Fed's Yellens semi-annual report. Okay, she came out and again, guys, she told the testimony. She reiterated the stance that the Fed was likely to hike this year. All right, so important. We've been talking about this. At some point this year, the Fed's going to hike, guys. Whether the economists think it's in 2017 or not, it's irrelevant. What's relevant is what the Fed says, because they, at the end of the day, push the button. All right, and then yesterday we heard about the leaked Fed forecasts. Again, the highlight of that was effectively that the Fed funds effective growth or rate is going to be at 35 basis points come the end of the year. That's their forecast, guys. Okay, from where we currently are at 14 basis points. So we spoke about this yesterday and we said, how are we going to effectively get 21 basis points from there to there? Okay, they're going to have to hike at some point this year. All right, what I do want to point out, Hilsenrath also made comment on this, okay, so important. He, in essence, has come out and he said that this month is likely too early for a hike, all right? Many economists think that September will be the likely hike, but traders think December. Okay, and we can see that because at the moment, traders are not pricing in the full effect of a rate hike. Okay, they're very nervous, and we've spoken about possible reasons. Simply put, it's probably because anyone who's taken on this trade as a trader has been hit 3 times now in a year and a half. By Ben Bernanke once, okay, by Fed's Yellen in March last year, and then obviously the October flash crash last year. Anyone that's tried shorting on the looming rate hikes has lost a lot of money. Okay, and that's probably why traders are a little bit nervous. They'd rather wait for effectively, Yellen to say, hang on guys, start pricing, start getting ready for a rate hike. Okay, and obviously he summarized by saying that Yellen has a little bit of a conundrum on her hands because economists think rate hike September, traders think December. Okay, so she has a bit of a signaling issue. All right, so at some point Yellen will come out a little bit more direct. She's going to change. She's going to be very, very, slight in the way she does it, but she's going to say something slightly differently, and that, guys, is our edge. And that's why we're doing this today, because we need to determine what is that edge. Okay. So that's effectively the rundown in terms of the statement.
And if I could just add something that I think is quite important. It says the Fed funds, in the leaked forecast, Fed funds effective estimate showed the average rate for Q4 is Q4 2015 at 35 basis points. So average Q4 is October, November, December. So if they just hike rate once in December, that doesn't give an average rate of 35 basis points. And I think we didn't highlight it here, but it says a 35 basis point average is not just achievable with deck. So they'd have to hike earlier to get that if they want an average rate.
Could see 2 hikes. Okay. Let's just quickly go to this document, and I want to just discuss something that we haven't done this before, but I want you guys, particularly for the newer guys, and particularly for the new guys joining us out there. Okay, I really want you guys to understand something about the Fed. Okay, so important, guys. The Fed's mandate. All right, full employment and inflation. Now, if there's anything you learn from today, just listen for the next 2 minutes because you're going to learn something, all right? That is taken care of, and we're going to see it in the data now. The Fed is not concerned about the employment situation, all right? They are very, very positive about the outcome for, the employment situation. What they are concerned about is this, okay? And this is where the nuance is going to come. This is where the opportunity for us as traders is going to come, because we need to understand when Yellen words something slightly different around the inflation situation. So the first thing to understand, okay, is the Fed continues to bang on about inflation in the near term being low, okay, as a result of transitory factors, okay, and she lists those transitory factors as 1 being the oil price, okay, or energy related prices, and 2 being effectively the US dollar. Okay, so she spoke and she said when these transitory factors start to fall out, inflation will then go back to where they think it would be, which is 2%. Okay, so we as traders have to analyze that because we have to look where oil is, where dollar is. Okay, because those transitory factors could go on for longer than what the Fed expects. Okay, then the second thing to understand is the Fed talks about the market's expectations of inflation. Okay, so what's the market's expectation? And the reason they want to talk about this is because it shows a sign of confidence. Okay, if the market's starting to price in forward rate, sort of forward inflation or inflation down the line, it's showing a confidence in the growth cycle or in the recovery of the economy. Okay, and that's why Yellen particularly makes reference. If you read through the statement, she makes very important reference to those 2 key things, guys. Okay, the market's expectations, and then obviously their own inflation expectations. Okay, so that's what I want you to understand. Any change, guys, around that, any wording change around inflation in the near term, if it's stabilized or it goes from being low in the near term to being stabilized in the near term, any sort of situation where she changes her stance on near-term inflation, that's the signal, guys. That's the clue around inflation. Okay, because the Fed is just waiting for the near term to tick up. The minute that near term ticks up, guys, that's the signal. That's the clue that Fed's Yellen is going to give us that inflation is going to start heading back towards they expect in the medium term. You all got that? Okay, let's get back. So let's go through the data quickly and talk about what we've seen over the last month. Now, NFP, we can get the chart up as you all seen, 223 versus the 225. Now, what I do want to point out, do you want to shut those lights off, please? Okay. All I want to point out with you guys is, in effect, it's all about the trend, guys, and that's why we've got that purple line. Okay, the purple line effectively shows us the trend over the last, sort of year, and you can see on average we're doing 244,000, and that's all the Fed cares about. Is we're creating, 225, 230,000 jobs every month over a consistent period of a year. There is a strong upward trend in job growth. That's what's important. Okay, then we look at the PMI manufacturing. We're not going to look at the chart, okay, but it continues to remain robust. Okay, manufacturing is looking very healthy, both from the manufacturing side and the non-manufacturing side. Okay, we then move on to the core CPI. Okay, these are the more key, guys. These are the key ones that the Fed looks at in terms of inflation guidance. Okay, so core CPI, very important. I've highlighted as green. We've ticked up to 1.8% now. Okay, so we're starting to see a little bit of froth in the core CPI. And if we look at the chart quickly, so important, okay, is what we effectively are looking at, and I point this out every single time, is that the Fed doesn't want core CPI back at 2% before they hike. Okay, they will have hiked well before we get to 2%, okay, because their job is to be forward-looking in terms of inflation, right? So what I do want to point out, guys, is we're right back, I was just to draw that and move out of the way, we're right back to that 1.8% almost ledge. Okay, so again, in terms of data, we need to be watching this core CPI very closely. If we get above 1.8, okay, the Fed's going to start to think a little bit. Okay, so that's the core CPI. Then if we look at the core PCE, okay, again a little bit closer to the consumer, it's the personal consumption expenditure. It's remained flat now for 3 months in a row. Right, if we look at the chart, very simply you can see that it's nice and flat on that 1.2%. Okay, but again, in terms of trend, we obviously want to see that moving back up towards 1.5%. Okay. If we then move on to the US retail sales, okay, we had a horrible stinking number, I think it was last week. Okay, nothing good about that. And this is where the Fed's worried, because the Fed gets a mixed signal. It's got all this wonderful health in the job space, and inflation in certain sectors picks up. Okay, but why aren't consumers spending consistently? Okay, and if you look at the chart, again, we've just been stuck in this sideways range for a long, long time, and the Fed does not want to see that, guys. The Fed doesn't want to see consumers suddenly backing off, okay, less demand. They want to see consumption from the consumer picking up, because that will maintain the recovery. Okay, so again, the only real alarming thing in terms of all the data was, one, the retail sales. Right. It's known that obviously the US economy is very driven by the consumer, so retail sales is something the Fed pays attention to. Okay, but more importantly, let's have a look at the inflation expectations. Okay, what I do want to point out effectively is from this point here, which is the last meeting, we can see that actually the market's expectation of inflation is starting to pick up quite nicely. Right, the market's actually starting to almost pay attention to the potential or the likelihood for inflation, okay, down the line in the medium term. Right, and that's important, guys, because that gives the Fed confidence. If the market and the Fed are on the same page, right, then Yellen will be far more confident in hiking rates because the market will be expecting it. Okay, so that was one of the positives that I'm sure, hopefully, Yellen will make mention to at some point. Right, and then the last thing what I want to talk about, let's have a look at the oil and the dollar. So important, guys. Fed Yellen's told us near-term transitory factors are a result of the oil and the dollar. So what I do want to point out is since the last meeting, which is again that yellow line there, we've dropped 21%. Okay, that's WTI. And that's alarming, guys. There was a big report in the Reuters yesterday talking about, are we going to have the deflationary scare again now that commodities globally are slumping as a result of China? Okay, so important, whilst oil collapsing is in essence, a positive for consumers, 21%, guys, in the space of a month is alarming for the Fed. Okay, and then obviously the dollar, if we look what the result is, as you can see from this line, that was the previous meeting. Okay, the dollar's appreciated by 2.5%. Okay, so again, those transitory factors in the near term are not disappearing, guys. And that's that's why Yellen is on hold right now, because she cannot suddenly go, well, transitory factors are disappearing, surprise, we're going to hike rates. Okay, so near term right now, it looks as though inflation's probably going to stay, steady at low levels until these transitory factors start to fall away. Okay, that's effectively the data over the course of the last month.
Okay, guys, so what's the market pricing? So in terms of market pricing, I always look at the STIRS, the Fed Fund futures, as that will give you the clearest interpretation of exactly what the market's pricing. So the current Fed funds rate is between 0 and 25 basis points. It's a range. The current rate is at 14 basis points. Last meeting in June, it was at 13 basis points. So it hasn't really moved. They're just kind of bang in the middle of that range. The Fed funds market is pricing the first rate hike in January 2016. Now, that's important to know because a lot of the analyst community, they're calling maybe September, maybe December, but the market is actually pricing January 2016. So always be a little bit skeptical of what you actually read, because what you read comes from analysts, not from what the market says. So economists at JP Morgan, Goldman Sachs, whoever, they're calling for September rate hikes, December rate hikes, but the market is fully pricing its first rate hike in January. And when I say first rate hike, I'm talking 25 basis points. So 25 basis points from the current rate. Some actually talk about first rate hike being from the upper end of that band, from 25 to 50, which I sometimes do refer to, but it seems more and more likely that they'll talk about rate hikes from the current rate. So the market is pricing the first rate hike in January 2016, or fully pricing it rather. There is a chance, obviously, every meeting, but it's only fully priced in January. Now, this time around, we don't have an updated Doppler, so we have to go on based on last month what the Fed were thinking. So they were thinking the end of the median Doppler at the end of 2015 would be 0.625%. Brannigan showed you that dot plot, they're all very converged. The median is 0.625%. The market, however, is only currently pricing, actually I think that's wrong, I think I did update it, but it's actually pricing 0.4%. So let me just correct that. So there's still a big discrepancy there. Earlier in the year, there was a bigger discrepancy than 20 basis points. That was closer to 35, 40 basis points. But still, even though the dots were reduced last time round, they're still not in line with the market. The market and the dots still have this discrepancy. If we go further out the curve, current Fed dots 1.625%, market 0.97% into 2016. End of 2017, dot plot 2.875% median, market 1.68%. So what's this telling us basically? So the Fed is telling us, according to the median forecast on the dot plot, that they may raise rates 1 to 2 times this year. So essentially going from 14 to 62.5. But the market's saying, well, actually, we think maybe just 1. If we look at 2016, the market's saying essentially 3 times, so 14 to 97, 325 basis point hikes. The market is saying a lot more, four hikes, so from 0.65 to 1.65. And finally, 2017, the dot plot is portraying 25 basis point rate hikes in 2017. The market's saying 3 times. So basically, what's this telling us? 1, the market expects a later liftoff from the Fed. 2, a much slower pace of rate rises. So when we're looking out for things in the statement, when they look about pace, when the first rate hike will be, what pace they'll go at, this is important because essentially, if we draw a little chart, if we draw a little yield curve chart, so yield time, the market is essentially something like this, and the Fed essentially much quicker rate hike cycle. Now, when the Fed last hiked rates in a cycle in 2004 onwards, they hiked at every single meeting for like 20 meetings for about 2.5, 3 years, from 1% to north of to about 5.25%, I think it was. Now, we're obviously we're not going to get that this time around because the Fed, if you think there's 8 meetings per year, so meetings every 6 weeks, Fed are thinking, 4 next year, 5 the year after, so it's kind of every other meeting. That's what the Fed dots imply once they start hiking rates. Not every meeting at all, which is what happened during Greenspan's time. So obviously these are a little bit stale now because these are from June, but always important to know what the Fed have guided us towards last, and also important to know what the discrepancies are like, because essentially, if the Fed come out and not hike rates, they could hike rates, but if they come out and give some guidance as towards, chances are they won't explicitly say, but we expect rates to be 50 points higher by year end, well, they're not telling us anything new. But the market still will move, or should move, because the market's not quite there yet. Obviously, as we go further into the future, it's harder to predict the future, so these can be a bit varied from each other, and it's pretty normal for them to do that. But I think in terms of this meeting, all the market is looking at, all the analysts are looking at, is essentially when that first rate hike is going to come. So to be honest, I think Deck 16, Deck 17 is a little bit redundant this meeting round. There's no dots update, so I think the market's focus will solely be on when this first rate hike is coming. And like I said, currently its first rate hike is fully priced for January 2016. Any questions regarding that, just before I go on? Okay. So, I think there are three main key things to watch for. Three things. So one is the economic outlook, two is the language and forward guidance, which I ultimately think is the most important this time around, and three is the global outlook. So with regards to the economic outlook, I won't spend too much time on it because Brannigan touched on it already, but essentially inflation, employment, growth. Now their mandates, as we said, inflation and employment, and as Brannigan said already, employment is pretty much under control. It's been, data's been solid for quite some time now, hasn't been really that much of a worry to the Fed at all, and it's really inflation that's preventing them from hiking rates. So what I ask, and what the Fed will be looking at, has the medium-term outlook changed? Now, within the statement, what did they say? Inflation is anticipated, this is last time round, inflation is anticipated to remain near its recent low level in the near term, but the committee expects inflation to rise gradually towards 2% over the medium term. Is that still true? If it's not, well, there's going to be a market reaction. It might not be because due to some of the transitory factors Brannigan's talked about, that medium term, okay, it could gradually increase towards that, but it might take a little bit longer because of these transitory factors that have sort of extended the low oil prices, the stronger dollar. But this is essentially what we need to look out for in the statement regarding inflation. And that's what's important. So, we're not having a press conference, there's going to be no other guidance, so statement is key. And that is the sentence to look out for. Has the medium-term outlook changed? They could reword this in a number of ways. They could maybe say they don't expect inflation to rise as quickly. I mean, they say gradually, but as quickly as they thought it would. The transitory factors could play a bigger part, but again, we'll do some scenario analysis of different things they could say tomorrow when we go through like hawkish, dovish, neutral type scenarios. Employment, I'm not really going to touch too much on it again, but what Yellen did say in her testimony was we are seeing tentative signs of wage growth. Wage growth was kind of their bugbear regarding employment. Payrolls data had been strong for a long time, but wage growth had been pretty slow. Wage growth ultimately feeds into inflation. How quickly your wages rise, how much more money you spend feeds into the price level. So we've seen tentative signs of wage growth, and that's a positive. So that could ultimately feed into inflation. And that's what Yellen indicated last time around. Growth, it's not part of the Fed's mandate, but obviously it impacts inflation, employment, and economic activity in general. And last time around they said economic activity has been expanding moderately after having changed little during the first quarter. So from this, inflation is very much the key. But overall, we always talk about inflation in terms of the data being important, etc., etc. This time round, it really is the forward guidance. This time round, the market is looking, when is that rate hike coming? You need to give us some guidance. You keep saying data dependency. Analysts are calling potentially for September. The next meeting is September. Will the Fed hike rates without any guidance? Well, maybe, maybe not. So what we're looking at in the statement, and we wouldn't have got this before because they haven't hiked rates for such a long time, not under Yellen, not under Bernanke. The last time they hiked rates, started a hiking cycle, was under Greenspan. So we have to go as far back as that to actually get some idea of the type of forward guidance. But that was 2004, that was 11 years ago. So we are clutching at straws a little bit, but it's important to be aware what has happened in the past. So, as I said already, general analyst consensus is settled deck. Yellen emphasized in her testimony earlier this month that she expects rate rises before year end, but July is too soon. So we can essentially rule out tomorrow as a potential moment for a rate rise. And I didn't put the market pricing for tomorrow, but it's essentially pricing in half a basis point. So nothing basically. It's more than just an outlier. So the Fed won't want to surprise markets by raising rates by the first time since 2006, the end of the last cycle, with no forewarning. But at the same time, they want to keep their options open. So going back to the last hiking cycle that started in 2004, we saw the Fed guiding the market one meeting before they hiked rates. They dropped an assurance that the Fed would remain patient. I've talked to you guys in months gone by about the patience language, and they added a term about hiking at a measured pace. Measured pace during that cycle was 25 basis points at every single meeting. It went for a couple of years. But essentially, they gave the guidance, the forward guidance, the meeting before they hiked rates. They then raised rates at the next meeting and then went on this hiking cycle. So that's just a bit of context as to what happened the last time they hiked rates. It was one meeting before. So if they are to hike rates in September, tomorrow is one meeting before. So just bear that in mind. In the April meeting, they debated whether to offer an explicit indication ahead of the first rate increase, as they did in 2004, but the minutes of the meeting showed that they chose not to do this. They went down a different approach. The minutes actually said that most felt the timing of the first rate increase would appropriately be determined on a meeting-by-meeting basis, meaning they could hike with no formal advance signal. So that's something to be aware of, guys. Just because they don't give any guidance, that doesn't mean that rate hikes won't come in September. The market will be very disappointed if they don't give any guidance. The market initially might take it as, this is dovish because they haven't told us about it. But they've said, in the last minute, it would be appropriate on a meeting-by-meeting basis, which essentially means they could just turn up in September, hike rates. And that fits in line with what they've said in the past. They're looking at data. They're data-dependent. They don't want to tie themselves in to say they're going to hike rates now and then hike rates at the next meeting, and the data comes in weak and they backtrack on that. So if they are data dependent, that means they're still looking at the data, still looking at inflation, retail sales. They're not time dependent. They don't want to put a time on it. The data is determining what they are doing. So that could be one reason to potentially for the Fed to keep it open-ended, as they have done for a long time. And if they do that, don't be shocked. Because we're talking about, the Fed should guide before they hike rates. If they don't guide now and they hike rates in September, would you guys be surprised? Well, you shouldn't be surprised, because Yellen has said she expects rate rises this year, and she might still say that, but they're just not giving an idea of when that first rate hike will come. I think the opportunity for us as traders will be if they do give some guidance, because at the moment we have nothing. But if they don't give some guidance, that's not to say nothing will happen. And there could be some good opportunities from a trading perspective, because the market will initially take it as dovish, but doesn't necessarily mean that rate hikes aren't coming. But in terms of the trading, we'll talk about that more tomorrow. Another thing that maybe could happen is the Fed funds rising to the top of the current band first. We said it's at 14 basis points. The current band is 0 to 25. Maybe the Fed hasn't been talked about, hasn't been flagged, but I think maybe there's a possibility that they'll get it to that top of the band first before they actually embark on a cycle. And just to summarize in general what the Fed have been saying, the committee anticipates that it will be appropriate to raise the target range in the federal funds rate when it has seen further improvement in the labor market, which it has seen, and is reasonably confident that inflation will move to its 2% objective over the medium term. That is it. That is the data dependency. And in all likelihood, that probably hasn't changed. So to put a time on it is difficult, and maybe the Fed won't want to be tied towards a time. It's more data. And finally, the last set of things, we've talked about economic outlook, we've talked about the forward guidance, the global outlook. Remember, the US economy is the exception as opposed to the norm. We've seen in the last couple of weeks Canada cut rates, New Zealand cut rates. No central bank in the developed world is hiking rates. Brannigan will talk about South Africa hiking rates and what have you, but they're an emerging market still. But in the developed world, no central bank is hiking rates. So the Fed is the exception to everything else, and this is why we've seen this dollar strength to an extent. Higher interest rates leads to a higher currency. Higher interest rates relative to other countries leads to a stronger currency, i.e. stronger dollar. So if we just go down here, global outlook, the dollar strengthened. This has implications for growth and inflation. A strong dollar with weak global demand can import disinflation. Now, we talk about again and again, it's the medium-term outlook of inflation that's important, and the Fed keep referring to that, but ultimately, these transitory effects, they will feed into the medium term, because, okay, in the short term, say, how long is the short term? 6 months, okay, strong dollar in the 6 months, lower inflation. But if the dollar remains strong for the next year, well, surely that's going to impact the medium term. It might just push back maybe slightly the pace at which inflation will get to 2%. So these transitory factors, even though they are transitory, that doesn't mean they're not important. The Fed doesn't see it as a problem, but in terms of what we're looking at, when the rate hike will come, it could just delay it that little bit. And same thing with oil. Brannigan showed the chart nicely, but oil prices have started to fall again since the last meeting, could feed into low inflation. The Fed have said numerous times that low oil prices in long term stimulate spending. Growth in the longer term will benefit from this, but in the short term it will feed into inflation. Short term effects will ultimately feed into the medium term effects and could still delay that rate rise. So obviously look out for these here, because they are important. Transitory doesn't mean not important, it just means it's not a worry for them, but it's still important towards when that rate hike will come. And finally, they didn't cite China in the minutes last time round, but since then Chinese stock markets have really taken a tumble. There's still talk about hard landing in China, slowdown in growth. I mean, since the financial crisis, China has been the engine of global growth. So if there are problems in China, this could ultimately affect the Fed's thinking a little bit as well. Now, to be honest, like I said, I think if I had to rank everything in terms of what we need to look out for, it is the forward guidance first, then the economic outlook, then the global outlook. But I could be wrong. But it's important to pay attention to all of these things. Okay, so tomorrow will be more of the fun stuff. We've been through the fundamental preparation. Tomorrow is about the trade ideas, how we can look to take advantage of anything the Fed might say or do. We'll look at the bonds, at the currencies, at the commodities and the equities, looking at some pattern plays, some trade plans, and as it says there, some opportunities are coming. This could be a really important meeting. This could be where we get the first signs of any guidance towards that first rate hike. By the same token, it could be a damn squib, but we still have to prepare, because this could be the best day of your year, and if it's not, well, it's not, but you need to prepare for it, and this is why we do this. You got anything to add, Brannigan?
Yeah, just what we meant by the opportunities are coming, guys, is that if you look at that screen, back in 2004, there you've got your rate hike cycle. Yeah, you can point it out, Imran. That's your rate hike cycle, and I mean, if you just look at a basic, I obviously wanted to show a spread chart because the guys that trade spread think there's no opportunity, but all I can see for almost 2.5 years is trend. Okay, so all I want to point out is that when we mean opportunities are coming, is if you look, we've been flat for so long. Okay, so what you have to ask yourself is, when rates go up, and this is what people don't understand, guys, is that no one is around since 2004. I don't know any traders that have seen an interest rate hike. Okay, and there's not many people in banks that have seen an interest rate hike. So no one knows what's going to happen when we hike, but I can tell you one thing. You can bet your bottom dollar there's going to be some incredibly big flows somewhere. Okay, and that's what we live for, guys. Traders live for rate hike cycles. That's what we live for, because money needs to be moved from A to B. And we just got to jump on the bandwagon. And that bandwagon, as we've seen, can be 2 years long, guys. You can make your entire career in 2 years. So get excited about it. Tomorrow could be a damn squib, but equally, tomorrow could be signal day. Fed's Yellen could come out tomorrow and say, listen, we're going to hike in September. Start pricing. Okay? You have to be prepared for that. If you're not, you're going to walk out and you're going to go, oh, I made 500 quid. You know, I'm so happy with my life. Okay? If she signals tomorrow, guys, it's biggest day ever for everyone in this firm. But we have to be prepared for it. Yeah?
So tomorrow, guys, you guys come with your plans as well. We'll talk about some of our ideas, but we want you to talk about some of yours too. So please be prepared. It's going to be more a discussion as opposed to today, which was me and Brannigan talking at you and giving the fundamental plan. Tomorrow is very much open-ended. Opinions matter. We might have missed stuff, potential opportunities. I mean, if we share everything together as a team, we can all benefit from each other.
Cool.
Great. Thanks very much. See you same time tomorrow, guys.
Thank you.